Okay, picture this. You walk up to the teller at your local bank, hand over a thick stock of cash, let's say 10,000 rupees, and watch as they carefully count it out and slip it into a drawer. You walk out feeling totally secure, right? You're probably thinking your hard-earned money is sitting safely inside some giant, impenetrable steel vault, or at least somewhere way safer than stuffed under your mattress. Well, in today's Explainer, we are going to completely shatter that illusion. We're looking at the hidden system behind every single bank deposit to uncover the totally wild, counterintuitive mechanics of what actually happens the second you walk out those doors. Let's get right into it. So, where does your money really go? It's kind of crazy, but it's something we rarely actually stop and ask ourselves. The exact moment you deposit that cash, your bank is already plotting how to use it. It absolutely does not just sit there gathering dust. In fact, your money probably won't stay in that specific branch for long at all. But wait, how can the bank promise to give you your cash back on demand if they've literally already moved it somewhere else? Well, to wrap our heads around this, we really need to completely reframe how we view the bank itself. You see, there's this massive gap between our expectation and reality. Most of us kind of picture a bank as this giant, glorified locker. You drop off your cash, they lock it up safely, and you grab it whenever you want. But let's think about this logically for a second. If banks only stored money, how on earth would they survive? They've got massive overhead costs. Think about it. They have thousands of employees to pay, physical branches to keep the lights on, ATMs on every corner, fancy digital apps to run, and some incredibly expensive cybersecurity to stop hackers. Just storing your cash earns them absolutely zero revenue to cover all that. The reality? Banks are businesses, and their main product, the thing they literally sell, is money. To make a profit, they absolutely cannot afford to let your money sit idle. They desperately need it to be moving. Okay, let's dive into this by tracking the actual journey of one specific deposit. Let's trace that exact 10,000 rupees we talked about earlier. You walk in, hand over the cash, and the teller updates your digital record. You check your phone, and boom, your balance says 10,000 rupees. But what actually happens to those physical paper notes you just handed over? This is where things get incredibly fascinating. Those exact physical notes you deposited, they aren't kept in some special little cubby hole with your name Sharpied on it. Instead, they get immediately swept up into one massive central pool of deposits. And here is the wild reality. Your bank balance is not a live video feed of your physical cash sitting in a vault. It's literally just a promise. It's the bank's contractual promise to pay you that amount when you ask for it. And because they've made you this promise, the bank is now totally free to take a huge chunk of that pooled money and use it for their actual day job, which is lending. Let's map out exactly how this constant flow powers the whole economy. Okay, step one, you make your 10,000 rupee deposit. Now, step two, imagine someone named Priya who really wants to open a bakery. She goes to that same bank for a business loan and they approve it. But they fund her loan using the deposits made by thousands of everyday customers, including you. Step three, Priya takes that cash and buys ovens and mixers for her shop. And finally, step four, the company that sold Priya all that equipment takes the cash she just paid them and deposits it right back into their bank. Now that second bank can use those new deposits to make even more loans. It's just this incredibly dynamic, never-ending cycle. And this brilliantly illustrates exactly how the bank makes its money from moving yours around. Because look, the bank isn't just acting as a friendly middleman for free. Let's say your bank pays you a 3% interest rate for keeping your savings with them. Nice, right? Well, when they take those pooled savings and lend them out to someone like Priya, they might charge her 8% or 9% interest on her business loan. That gap, the difference between the tiny interest they pay you and the much higher interest they squeeze out of borrowers, that's the core profit margin that keeps the bank's lights on. Now, of course, that interest spread isn't their only hustle. Banks have a bunch of other revenue streams. They charge processing fees for almost every transaction. They hand out credit cards that carry their own hefty fees and interest rates. They handle massive corporate business loans, and they even offer specialized investment services. But listen, the whole shebang relies on one absolute fundamental truth. The faster and more efficiently money circulates from savers to borrowers, the more profitable the bank gets, and the more the banking system fuels the broader economy. The climax, creating money. Now, what's really interesting here is that we talked about how banks move your money around, but they actually do something far more powerful. They are the hidden engine of the economy because they literally have the power to create money out of thin air. Let me explain. This brings us to what we call bank money. This is digital money created by commercial banks the exact moment they approve a loan, which directly expands the money supply. Seriously, think about it. When the bank approved Priya's bakery loan, the manager didn't jog down to a vault, grab stacks of cash, and hand them to her in a briefcase. No way. They literally just sat at a desk and typed some numbers into a computer system, crediting her account with a brand new digital deposit. The split second those keystrokes happened, new money that literally did not exist before, was created and injected straight into the economy for Priya to spend. You know, it's a huge misconception that only the government or the central bank can create money. There is a really crucial distinction we need to make here. The Reserve Bank of India, or RBI, is the one responsible for creating physical currency, the actual paper notes and metal coins. But the commercial banks, they are the ones creating digital bank money through the sheer act of lending. In fact, if you look at modern economies, the vast majority of the money supply exists purely as this digital bank money, conjured up by private banks giving out credit. But hold on, before you go thinking banks just have this unlimited magic money wand, let's look at the flip side. Just as money is created out of thin air when a loan is issued, the exact opposite happens when a loan is paid back. As borrowers finally repay those loans, the digital bank deposits actually shrink. That newly created money effectively just disappears from the money supply. Poof. Plus, banks can't just run around creating unlimited money whenever they feel like it. They have to operate under strict, heavily regulated systems overseen by the RBI. Those rules dictate exactly how much capital they must hold, the liquidity they need, and how much risk they're actually allowed to take on. So we're looking at this massive, complex, interconnected system built entirely on digital promises, pooled deposits, and lending out the vast majority of everyone's cash. Which naturally brings up a very tense, kind of terrifying question. What if everyone wants their money back today? Seriously, what if every single depositor woke up, walked into their branch on the exact same afternoon, and demanded all of their physical cash back? Well, this absolute nightmare scenario actually has a name: a bank run. It's what happens when panic spreads like wildfire, trust completely breaks down, and thousands of customers rush to withdraw their physical cash on the exact same day. Now, because the bank has already lent out the vast majority of its deposits to fund things like 30-year home loans or 5-year business loans, they simply do not have enough physical paper cash sitting in the vault to pay everyone at once. Those assets, the loans, are tied up long-term. You can't just magically snap your fingers and turn a house back into instant cash. Now, don't panic yourself. Just because a bank lacks immediate physical cash doesn't automatically mean they're completely bankrupt. To prevent this kind of mass hysteria and protect the whole system, there's some major safeguards built right in. For one, banks are legally required to maintain a certain percentage of liquid assets that they can access super fast. They're also bound by strict RBI regulations to ensure stability. And crucially, for you and me, our deposits are protected up to specific limits by deposit insurance. But at the end of the day, all of these safeguards really just serve to uphold one single, absolutely vital element: trust. Trust is the literal bedrock of the entire global banking system. So let's bring all this high-level macroeconomic theory back down to earth for a second. Let's bring it back to you and back to that original 10,000 rupees you dropped off at the teller. It didn't just sit there gathering dust in the dark. While it was out of your sight, it might have helped a family finally secure their dream home. It could have helped a student afford their college tuition. Maybe it allowed a local farmer to buy a much-needed tractor, or a small business to buy the equipment they needed to hire more people. Your money, simply by sitting in your account, never actually stopped working. This constant circulation from savers to borrowers is literally the engine that allows modern economies to grow. As you can see, without this hidden engine, businesses would completely struggle to expand. Families couldn't easily finance their homes, and economic growth would just grind to a screeching halt. Banks don't keep your money because they were designed from the ground up to move it. So, I'll leave you with this final mind-bending thought. The next time you open your banking app and check your balance, don't just see a static number representing what you own. Ask yourself, how much of the world is your bank account helping to build right now? Because your money is already out there, actively shaping someone else's future. Thanks for joining me on this explainer, and keep questioning the systems around you.